Good afternoon. My name is Julia Coakley, Head of Operations at the MGAA, and I'd like to welcome you today to our webinar that's being delivered by Davies Group. Before I introduce our presenters, just like to cover a few housekeeping points. Please may I ask that your camera and microphone is off, and if you'd like to ask a question, please revert to the chat button at the bottom of the screen. If we don't get a chance to answer your questions at the end of the presentation, our presenters will answer these post-event. This presentation is accredited by the CII for CPD points, if relevant to your ongoing professional development, and the video will be available on our YouTube channel and uploaded to our website. We will also send the slide deck post-event. Finally, please take time to respond to our feedback survey, which does enable us to put on the best quality events for our membership. So today's webinar is the digital evolution, how technology can help your MGA turn into a full stack insurer. I'd like to introduce Chris Butcher, CEO of Intermediary Services, Dean Rowe, Group Chief Marketing Officer, and Chris McElduff, Chief Customer Officer, Consulting and Technology. Chris Butcher is an experienced CEO and INED with a demonstrable history of working in the corporate insurance and consulting industry with a particular focus on startups. Skilled in commercial insurance, personal insurance, casualty insurance, reinsurance and management, Chris has a strong business development and operational management experience. Dean is a member of the executive management team, and prior to taking up his role at Davies following the acquisition of Keogh's, he was responsible for developing and marketing a number of innovations and product offerings within the insurance industry. And Chris McElduff is responsible for developing the Davies Group's core propositions to ensure that the combination of these add value to their clients and customers alike. So Chris Butcher, if I might hand over to you.
Yeah, thanks very much. Yes, good afternoon, everyone. I must say I'm looking forward to the day where we can start doing these things again in person rather than on webinars. But in the meantime, I will talk a little bit about a high-level commentary. So I'm going to start today's session with a discussion of some aspects of an MGA, comparing it with a full-stack insurer in today's digital environment. The space I sit in within the Davies Group is that I run a regulated MGA platform working with startups from their earliest stage of development. In my area of the business, we typically help startups for around 3 years, during which time they establish other business needs, which we can fulfill elsewhere in the group, claims administration being a good example. After my introduction, my colleagues will talk through some specific tech solutions which both MGAs and insurers support their growth. And I guess that's the more interesting part in terms of the depth of knowledge. But in the meantime, if we look at what's changed in the last few years, I'll start with a run through of relatively recent history. We regularly look at insurance compared with other industry sectors and typically and correctly identify that insurance tends to lag behind. Hence, it's around 10 years since us as individual consumers have become familiar and comfortable with shared economy platforms like Uber and Airbnb. What's not always so clear is that these platforms couldn't exist without insurance. Getting these businesses running has required the build-up of knowledge, tech, and a decent degree of regulatory understanding in our sector. So in my experience, much of the change in the last 5 years has arisen from a combination of tech entrepreneurs and the more forward-looking insurance entrepreneurs, either combining or sometimes in parallel pushing in the same direction. The tech entrepreneurs have often spun out of the large successful tech businesses, or they've been software specialists in large tech firms. As an observation, and in terms of success to date, I have to say that most often it's been the experienced insurance practitioner who's come out ahead. This is partly due to the large number of barriers to entry in UK financial services, of which complexity and opaque structures figure highly, as many of us know. Very often the tech ventures, which are based on the growth in the shared economy, are running platforms which rely on a form of embedded insurance. And fundamentally, this isn't really a new concept. Aligning scheme business to a specific sector, this sector need has been around for many years, be it something like solicitors' PI coverage or trade insurance for electricians or plumbers. But what has happened in the last 5 years is that the new entrepreneurs entering the insurance space have often tried to look at insurance differently, most often reflecting on their own personal experiences. Some even look completely afresh, contemplating whether there's an opportunity to reimagine the current insurance world in a sort of back to basics or what's it all about fashion. And this recognises that customers really need a simple solution to all worry that they're carrying a risk in their lives that can be significantly reduced or removed if it's shared with others. I guess for me, one obvious example and proponent of this principle might be Lacquer, where Toby identified that a solution and rethink was needed when it came to the insurance of bikes. The element that's also different now is the digital platform and the customer interaction. Over recent years, I've been fortunate to work with some truly innovative insurtech clients, and all have had different journeys to finding individual success. The overall product range is very varied, but if I look at, say, motor MGAs as an example, the names include Insurer, who are working with Uber, Ticker, which has an initial focus on helping young drivers who just passed their test, Drover, which reimagined the concept of choosing a different car whenever you wanted one, Lenny, a Jaguar Land Rover back-to venture, which was pay-as-you-go insurance, to name but a few. But a key differentiator in all these examples is the customer journey, and making the interaction with the end consumer a simple and pleasant one. I mean, others which are not related to the motor market, like Nimbler, is truly innovative in finding that small businesses couldn't buy specific insurance to protect just the element which kept them awake at night, but were being offered something much broader. The small business worry was that on occasions they're not being paid by their debtors, so Nimbler identified that allowing them to insure an individual invoice was fulfilling a genuine need. To do so requires both a highly user-friendly customer interaction and a sophisticated analysis using algorithms to price the risk on the SME's invoices. So they use leading indicators to calculate the price of protection against customer defaults in real time. I mean, their story is multifaceted, but technology is at the core. So why think about transitioning from an MGA? The driver for this change is the upside in value. It's the financial impact. An MGA may well have profit commissions in order to share the underwriting result, but most commonly consideration is given to finding other ways of retaining underwriting or portfolio profit. Sometimes this will be by looking at a captive solution, sometimes by creating a Lloyd's syndicate in a box, sometimes by the raising of sufficient capital to create an entirely new capitalized insurer. Each route has its own pros and cons and associated costs. An insurer will need to carry a much higher cost base, and the overall capital efficiency must be assessed. The even more extensive regulatory hurdles and the associated personnel requirements, ranging from actuaries to risk managers to more compliance officers, translates to a higher fixed cost base. So, as many of us know, this gives the MGA model an initial edge in terms of margin, agility, and funding needs, particularly in the setup phase. But depending on the growth of the insurance portfolio, it's often considerably longer that it's worth staying, in my view, as an MGA. I mean, MGAs also far outnumber insurers, and new full-stack insurtechs are relatively small in number. The well-known examples in the US are those such as Metromile and Lemonade, but even those two large participants are shortly to become one, while the MGAs, like the ones I mentioned earlier, are examples of working with an MGA model and collaborating with incumbents like Munich Re or other strategic carrier partners. We'll drill down a bit into the underlying business models. It only helps us understand a little more. If we start with product, for example, this is where the differences appear to be the greatest. Most of the time, a startup MGA will have little leverage and hence rely on a partnering risk carrier having a significant say in the insurance product. This will include the terms and conditions, underwriting rules, and pricing. This means that for an MGA, it might have to choose to source products from the risk carrier's existing portfolio with some customization. In rare cases, it is possible to develop products from scratch with a degree of freedom that resembles that of a full-stack insurer. The fact that MGAs can leverage the risk carrier's resources and in some cases even collaborate with multiple insurers allows for a shorter time to market, efficient product development cycles, and quick expansion of the product portfolio. However, although in theory full-stack insurer has immediate full control over every aspect of the insurance product, in reality it's much more complicated. Not only may regulatory matters slow down product development and time to market, but so may qualifying requirements of reinsurers, which new full-stack insurers typically heavily rely on to manage their regulatory capital, proportional reinsurance being an element of capital relief. A new full-stack insurance player may quickly find itself entangled in the complexities and dependencies of regulation, which can draw attention and resources from its actual core value proposition. Next, we talk about customer relationship. It's the area of customer-facing activities where the differences can exist, but also can be obscured. It's unsurprising given that most B2C-oriented MGAs and the full-stack players alike have distribution and customer engagement at the very core of their business model. And this we're going to touch on a little bit later. Whether it's a sleek app or web platform, customer service or payments, usually these activities are fully controlled by the respective brand. I guess most notable differences can be found in two areas: claims management and branding or co-branding. In claims management, the MGA's risk carrier in some cases retains the review and decision-making of the claims process, although communication and settlement can still be channeled through the MGA. Alternatively, claims management might be outsourced to a third-party provider, TPA, an option that is also chosen by some full-stack insurers, and hence we as a group work with both. Co-branding is an option available to MGA players, whereby they can feature the risk carrier more or less prominently as a trust signal in their promotion of their product. I think the big question, if thinking about transitioning from an MGA to an insurance risk-bearing entity, is which elements are critical to future success? What does that insurer of the future need to have particular strengths in? Today, most often, it's data and tech. So digital solutions, if I revert to the core theme of utilization of digital solutions to achieve the goal, it's worth running through some of the typical elements which remain key topics of the year. Well, fundamentally, the business must have customer-centric solutions, and this often relates to an end user's preference about interaction with the service or product provider. And very often on B2C business relates to app or smartphone to create that interaction. It also relates to creating the optimum customer experience. Again, you'll hear about some specific areas later on from my colleagues. Embedded insurance is still a hot topic. It's key in my world, where around 50% of new inquiries come from the non-insurance ecosystem. Covered this a bit earlier, but typically I'm referring to a linkage between a core product provider and insurance acting as an enabler, as in the case of Uber or Airbnb, or sometimes it's a complementary financially accretive add-on. Unstructured data. Now this topic is one that I think comes up later in our presentation. AI, if we talk about artificial intelligence, most typically applied in our sector as automation and machine learning. So one of our MGA clients, which is Sequence, is using machine learning to help pre-populate policy documentation and record referral information. So this enables an automated response or more detailed information to be sent to the underwriter in answer to subsequent queries. The platform's underpinned by more than 50 external data sources. Natural language processing and machine learning means the platform learns and anticipates how risks evolve to continually improve automation capability. This speeds up quotations and underwriting by reducing the number of questions asked. As they've said recently, this allows underwriters to be freed from repetitive tasks to concentrate on the more interesting, rewarding, and valued aspects of their profession. Machine learning also improves customer service by allowing underwriters to radically improve the service levels currently experienced by brokers and their clients. I've thrown in blockchain, which should have become a more central part of our ecosystem, but doesn't seem to have gained the traction that most expected, so we'll see where that one goes. Behavior-based data, I think, is much more crucial, much more critical. This most commonly relates to having multiple data points, and it captures a far greater number of pricing and rating factors than we've had in the past. We go back to the core theme. Has anybody actually made the transition that I know of from MGA to insurer? Well, I should mention that two of our current clients have developed from MGAs to carriers. Carbon is still an MGA client, but which has formed a syndicate in a box. at Lloyd's is managed by Astor Managing Agency. And in the B2C space, GetSafe are our best example of a client moving to be a full stack insurer. GetSafe provide insurance for gadgets and home contents, and they launched successfully in Germany, coming to the UK in 2019. They were very aware that the insurance market is difficult to enter due to tight regulation, high capital needs, and a massive variety of incumbents. However, they recently raised $93 million in a Series B raise and are focused on staying B2C. They've very recently become an insurer in Germany, and they're still an MGA client in the UK for the time being, but watch the space. So in conclusion, we at Davies provide a regulatory operations and infrastructure wrapper around the startup MGA when it really thinks about the beginning of its life. As the MGA business matures, we tend to offer more and more services. I like to think that in the round, we can provide around 90% of all an insurer needs by utilising our broad range of professional services. My colleagues will now give some insight on specific areas where we have strong digital capability and can highlight how tech can be used to develop more profitable business. I think these elements underpin the sort of future of insurance and improved life cycle for customers. So on this note, I think I'll hand over to Chris McElduff, who will move us into some more detailed areas. Thanks very much. Chris.
Great, thank you, Chris, and good afternoon, everybody. Yeah, I'm Chris McElduff, as was introduced. So I'm from the consulting and technology part of the Davies business. So quickly on consulting and technology and what we do. Essentially what we do is we help organizations, insurers and organizations in other markets to improve the experience for their customer and also for their colleagues within the business. And the way in which we do this combines a number of different things, which at the heart of it is really about personalizing experiences by using data and fundamentally looking to try and reduce or remove effort and friction from those experiences. Now, those experiences can be increasingly digital, so in fact they can be entirely digital on an end-to-end basis, or they can be what we call omni-channel experiences, where a customer may be conducting a journey or following a process on a digital channel, but at times they may need, or we may decide they need to speak to and get some support from some of our colleagues. So really it is about how do we use data at the heart of that to make those decisions, and then technology to connect in there. And we do that really, I mean, there's 4 pillars to what we really offer and help customers with. We create those digital journeys and use data to drive them. We help people improve the operations that underpin them. So when colleagues need to help in those journeys, how do you have the right operating model and capabilities there? Part of that is about finding. And then one of the pieces that I'm going to talk to in just a few seconds is about how you use analytics technologies to create insights in either real time or in near real time from structured and unstructured data to improve those journeys and take the friction out and do some other things. And what this all translates to is value through 3 lenses, if you like. The first is a customer lens, and if you improve the experience, making it easier, less friction, and the customer will kind of value that. So there's a retain and grow aspect of value to getting it right for the customer, which I think is well understood by everybody. But equally, if you look at it through the colleague lens, particularly in the market just now, where attracting and retaining colleagues is a big challenge for every business rather. Making the job easier and more fulfilling and equipping them with the right digital assets and information to do that job will help them feel connected with the business and fulfilled with working in the business. And then the third aspect is the business value. So get these 2 things right, customer experience and employee experience, and some of what I talk to will then translate into business value. Now that business value might be about reducing expense or optimizing expense, or it might be in insurance about reducing indemnity. But whatever the measure is, it's about creating value through those three lenses. So if we maybe go to the next page here, what I'm going to just do is quickly talk about unstructured data. And look, as Chris set out in his introduction, the combination of digital and unstructured data is really where insurers and others are really focusing on to kind of create value for their businesses. So first thing I thought I would talk about was just what is unstructured data, to make sure everybody was clear on what that was and how we look at that. So unstructured data really is data and information that has been historically locked in written communications, formatted and semi-formatted documents, locked in telephone conversations, locked in email communications, locked in chat communications, either with human advisors in service or claims centres, or with bots increasingly. So that data in an unstructured form really is a gold mine, because what you're seeing in that data is a whole load of stuff, ancillary insight that customers are sharing with you as they are engaging with you, that often doesn't get captured and translated into structured forms by, be it service or sales advisors or claims advisors. So really now, with the advent of some technological innovations, that data is now accessible. And as I said, it's a gold mine, which when you extract it and combine it with structured data, lets you do some really interesting things. It lets you make the journey much easier for customers and colleagues. It lets you personalize it, as I said. It lets you create new layers of protection where there might be risk associated with customer journeys, be they risks on the customer side, which might be to do with vulnerability, or be they risks to do with aspects such as fraud. So you can add to protection layers that you've got, which clearly, as you scale up a business, become a different aspect. And what you then do is you combine that with digital solutions to prompt action in real time or near real time to address some of those kind of risks. So I'm going to talk about an aspect of structured data in the next couple of slides that's to do with speech analytics and text analytics, where we're mining insights from those interactions with customers. My colleague Dean will then talk in his section a little bit more about documents and how you can unlock the value from documents. So the next slide, please. There's three aspects to this. Just so quickly, we're not talking about one aspect of technology here. I think when we look at speech analytics solutions, there are three elements to that, which are, the first one is taking that audio conversation and turning it into text. So that's what we would call speech to text technology. And in all three of these aspects, there are different technologies and technology providers that can do that. But in this concept of speech analytics, that's one. The second one, as Chris had touched on earlier, is natural language understanding and processing, which is looking for patterns and the ability to be able to interpret and combine those patterns and interpret those patterns in the unstructured data. And the third component is AI and machine learning, where what you are constantly looking to do is evolve your model and learn and improve that model without relying on the human being kind of updating that entirely. So there's lots of technology options and suppliers in this space with different capabilities. And when I think about speech to text, they would be, some vendors would be better in some languages than others. So knowing the landscape is really important. And what I would say with technology components is actually there's a human capability to all this as well. So when building these solutions, there is a kind of, I would call it a people operating model that you've got to put around some of these technologies to ensure that you get that right. So I talked in one of my earlier slides there about, if we go to the next slide, please, value. So I've got a couple of specific examples for insurance on my next and kind of final page. But what I thought I'd just share at this stage is just some what I would call typical use cases that growing businesses are deploying and using these technologies to uncover. So the first one I thought I would share was back to that aspect of the customer journey. So we're using these speech and text analytics technologies to really understand why customers are having to contact us, because that might be because there's some underlying issue or process failure that was avoidable. So we're able to use these technologies to look at those customer interactions and look at failure that's associated with another part of the journey that resulted in the customer having to contact us, which clearly is bad from that customer experience point of view, and it's a very kind of clear cost to a growing business. The second area is in selling, and well, there's actually a few elements to this area, but we see customers using this in the selling kind of part of their business, looking at our opportunities being missed or opportunities not being exploited by sales advisors effectively. So we're looking there for things like where the appropriate offer's been made, where the appropriate sales techniques been used, and are we getting consistent outcomes across our colleague pool there. The same thing can then be applied to kind of aspects of mis-selling. So we can use this technology to look at risks to make sure that we're doing the right things. And then, using the same kind of principles of looking at things that are said and not said within conversations, we can also then expand that out to look at other risks. Other risks might be a customer dissatisfaction, which could escalate to be a complaint, or in other cases it might be indicators of fraud, so language being used which is indicative of that. The other couple of examples of use cases I wanted to share were around kind of product and competitor insights. So again, in the process of engaging and interacting with a customer, they tend to talk to you about many more things than the specific action they are asking you to take. And that information rarely gets mined. And off to the side, we're often asking customers for their feedback and doing customer research when there's a goldmine of information here that can tell us in their own words what the issues were. And then two more. One of them is just operational performance. So again, in a growing business, we tend to have a distribution of performance across our colleague pools. So knowing what good looks like is one of the aspects that speech analytics helps us understand. So if we can look at a servicing or a claims agent and look at their performance metrics, and we want to try and understand what they do and what they do effectively versus some colleagues who might be not as strong in some other areas, speech analytics lets us drill into some of those differences, and then package them up and feed them into kind of coaching activities so that we can start to get teams to perform better. And then that end-to-end process, the ability to look at the end-to-end conversation also lets us look at our teams following the processes that underpin our approach. And this is where being able to assess that and turn that into a measurement lets us look at quality and compliance monitoring, which again, in a business that's scaling, in a business that will have more interactions with customer, moves from being something which is a small, often statistically invalid sample to being something that can be scaled up and be automated so that the business can kind of grow and grow without the level of risk growing, essentially. So that's just a few use cases. And what I thought I would do on my last page here was just bring that to life in respect of insurance specifically. So I've got 3 examples here that play to the typical kind of insurance journey. I've got a sales example, I've got a kind of, you know, a change MTA kind of example, and then I've got a claim example. And in all of these, you know, what we're doing is we're using the speech analytics, as I said, to focus on, are we doing the right things for the customer? Are we kind of doing the right things and protecting our employees? And are we creating value from the intersection of those two? So the first example is on the sales side, where in this example, this is about listening to that sales conversation in real time. And while we're doing that, we're looking at the things that were said by the customer and by the colleague, and also the things that were not said that perhaps should have been said because something had been said previous to that. So what this allows us to do is look at how our colleagues are managing the sales interaction. Are they listening to the customer need? Are they offering things that are appropriate? Are they using the toolkit that we often have in sales around product features and aligning them to the need as effectively as they could? And using the speech analytics in this instance, what we are doing in real time is triggering actions and prompts using the right kind of digital interface so that our colleagues can adapt their approach as they go through the call. Ultimately getting to a point where we're listening, we're making the right offers to customers that meet their needs, and we're doing that more consistently over a growing kind of advisor community as the business grows. The second example is on the midterm adjustment, again using the same kind of technology principles that I described, but the opportunity in the midterm adjustment, the MTA here, is to listen for those things that might be indicative of changing circumstances for the customer. So all too often in an MTA, it can be about, the customer says lots about what they're changing, why they're changing, but the handler or the service advisor will just act on the add the car, you know, or the outcome, you know, that was requested. But very often what's missed is what's the reason why that change is happening. So the relevance of that is that we might see changing circumstances where the customer is experiencing some life events that make them vulnerable. So actually, as a responsible organization, we should be using that, and we should be making sure that we're doing the right things by the customer. Now, those might be financial vulnerabilities or other vulnerabilities, but this activity, this technology lets us flag that and take action off the back of it. Similarly, it can be life events, for example, again, which are indicative of a customer retention and a customer development opportunity. So where we might be looking to grow a lifetime relationship with a customer around protection, it's highly valuable to us as the insurer to be able to offer to the customer products and services that match their life situation. So that could be growing families, it could be moving home, it could be moving job, it could be any number of events. But the point is that information tends to get lost, and this technology is a goldmine for pulling that out, which I think we would all agree that lifetime relationships is where any organization wants to be with its customers. And then the last example is in the F&O space, which obviously we all know the claim experience can be the pivot point of any relationship between an insurer and so getting it right in the claim space is really important. But again, as we all know, it can be quite a fragmented and elongated journey for a customer. So what we are talking about here is how do we use that initial first notification of loss engagement, which is most often done via the telephone, but increasingly that will be digital, and part of that digital experience will be about messaging. So we can apply the same technology to messaging, but how can we listen more effectively on that first notification of loss, determine more effectively liability at that stage, determine where there might be recovery opportunities if it's a motor environment, determine that there might be fraud activities or fraud indicators there, and essentially use that in either real time or near real time to go and do something that makes it easier for the customer. So with some customers, some clients rather, when we look at how we're using this technology, ahead of using this technology, they would be dealing with first notification of lost calls, and their priority on them was to get the customer, this was a motor customer, get the customer home safe, get them into the repairer network. And then they came to the liability question further down the line. And their approach was they were then going and requesting further information that had actually already been disclosed at the first notification of loss. So it really is about how do we speed up the claim cycle, take the friction out of it, avoid duplication things, touching it less where we don't need to touch it, and ultimately reduce the cost and the risk of that claim. So when we do these things, really using speech analytics, what it lets us do is, build these analytics, apply them into the business, and then scale them up as the business grows and use automation much more than human hands-on touch for some of these things. And that then that takes us into an area where we as the Davies Group are then combining these technologies with other automation technologies to drive, a further improvement in that removal of friction, shortening of the journey time, and obviously the value creation that talks about. So I'm going to hand over to my colleague Dean now, who's going to talk a little bit more about some of the other examples I mentioned.
Okay. Thank you, Chris, and good afternoon, everyone. Now, for the final part of the webinar, we're going to delve in a little bit more detail into the claims journey, and in particular how certain claims types can be automated by the use of technology, and ultimately how that technology for a forward-thinking MGA or insurer is going to set the pathway for the coming years. Now, to start off with, I'm going to start off with a prediction. A prediction that, courtesy of McKinsey & Company, which this prediction came out about 18 months ago, certainly pre-pandemic. And it suggested that by 2030, 70 to 90% reduction in headcount in the handling of claims would be expected. Now, it's quite a bold statement, 70 to 90%, but obviously forward thinking in terms of this, between 2021 and 2030, there's a significant amount of technology that can be consumed and a certain amount of development, which will obviously, I say, that would actually come forward to make that prediction a reality. And indeed, I think from where we are here today, there's a number of technologies already out there that will potentially challenge this and actually bring this forward by a number of years. The relevance here is obviously from an MGA going into this market, the life cycle of an MGA, by 2030, the environment that you will be going into, potentially will be looking at your operational expense significantly less than it is now. And more importantly, with these technologies, it's not just about the operational expense, but it's also the indemnity spend that they will have an impact on, and a positive impact at that. So let's now just take a look at some of the enabling capabilities that are currently out there to automate parts of the claims journey. First and foremost, data is prevalent in everything that we do. And Chris had mentioned previously in terms of how unstructured data is the key to this, and unstructured data constitutes now over 85% of all data that obviously is captured on a particular claim. But it's more than that in terms of you've got data coming out of telephone calls, you've got data coming out of structure, you've got data coming out of internet, you've got data coming to us from all angles. And fundamentally that enabling the capability of the power of data should give you deeper insight, not just into the claims profile, but also how claims can be better automated and how you can make better decisions from that data that you're able to embrace. The second thing is workflows are getting better. Claims workflows are becoming becoming a lot easier to develop. It is very easier there's lots of technologies out there now that can automate parts of the process. And more importantly, the speed to be able to develop changes in that workflow is becoming even quicker. So fundamentally, as claims profiles change or processes change, then the workflow systems are now out there to be able to adapt. The third point, which Chris has mentioned in terms of telephony, we've obviously got a significant amount of unstructured data that can help in terms of speech analytics. But more important than that, and you'll see as we go through this presentation, there's a hell of a lot of data within documentation. Majority of the things in the claims process still are heavily unstructured data and document based, whether that's from claim forms, through to invoices, through to engineers' reports, through to even loss adjuster type reporting. Fundamentally, these are generally all within the unstructured data space. The next point is the process is becoming easier. Claims are becoming able to be processed on a straight through manner. And more importantly, these processes, and as you will see from an example that I will pop up in a second, things such as the official injury claims portal are there to make claims processing easier. So a lot of the complex processes that you would have to be able to hand off, or even in case of where you're actually using third-party systems to link into the process, for instance, looking on DVLA for driver details, that has become a lot easier. Technology using APIs, etc., has made it a lot easier to actually engage with. And then fundamentally, the final bit, which is automation and people's attitude to automation, and particularly insurance attitude to automation. Fundamentally, we've gone away from the angle, which is you can't automate some of these claims, more to a case of what type of claims are more able to be automated, what values are can be automated up to, and also people's attitudes in terms of operational expense, and also and people expense in terms of handling these claims on a manual basis. So fundamentally, what we see now is a sea change in people's attitudes towards automating claims that previously would not have been there a few years ago. Now, when combined, these capabilities really give you a powerful edge in terms of how you look at your claims processing. So as you can see, there are less reasons to automate, less reasons to adopt technology. And also the fundamental point is you can get a competitive edge here by obviously adapting this level of approach and technology to your claims profile. Okay, how do we go about doing this? Well, ultimately there's 3 decisions you need to make in terms of the automation options. First and foremost is there will be a number of claims that you will wish to automate end to end, if it's all possible. So these are the less complex claims where the cost of these claims, the cost of risk mitigation is more than the claim themselves. So for instance, things such as personal effects type claims, things in the areas where mobile phone type claims, etc., etc. Some of these are easy, less than £1,000 type claim values, where the actual routine processing can easily lend itself more to automation. And in that sort of bucket, you should be looking at high 80s, 90% level of straight through processing, ultimately in terms of these type of claims. The second decision would be, how do you obviously move to almost a partial automation level where you're using technology to augment the claims handling. So this is where you can take big areas of the claims process, automate those areas, but still have a human touch on those, albeit not a claims handler managing the case end to end. So for instance, this may be high levels of automation to do some of the routine work, but then packaging that up so there's a point at which you can then facilitate a claims handler making a decision before you go through and automate. And again, typical areas here, which will be more significant values, such as, for instance, motor vehicle damage, etc., which would have high levels of automation, but still may have a human impact input in terms of making a decision. And then the final thing, which is using this technology to look for those exceptions. So start to look at the claim patterns for things such as large loss indicators, let's say, or for indicators of fraud, where you're using the technology not to automate the actual processing of the claim, but to automate some of the triggers that obviously need to be referred into specialist handling and specialist complex handlers in terms of that claims process. So fundamentally, applying this type of approach to automation of claims then gives you the ability to, in effect, section the claims processing and obviously make best use of claims handler resources to reduce your operational expense. Now, if we move on to the next bit, which is, as Chris mentioned, voice is one area of unstructured data, but we also see that documents are the significant element here in terms of being able to automate claims. So now, more than ever, technology is there to be able to replicate a human claims handler reading a document with technology. So fundamentally, teach it using things such as machine learning and using areas whereby you can use technology that's well established now, using OCR and machine learning to then really get into the detail of the document. And in effect, this is not just around indexing a particular document type to then do keyword searches, but it's reading the document in the way that a handler would do so. So for instance, if it's a medical report, teaching the machine how to read the medical report as if it was an experienced personal injury claims handler. Now that's the key really, because in terms of doing it that way, then you're able to teach a machine how to do this and then be able to then obviously routinely automate better. Whereby previously, the type of technology in this space would have been limited to things such as OCR and text mining. And this then becomes what we call the secret sauce. Once you can start to then use technology to read documents and then apply that into a claims journey and the steps of that and use different combination of technology, you can then start to think about how you can easily automate some routine claims. So how do you do this? Well, first and foremost, you use things such as technologies that combine and work together into a seamless journey. So if you just move to the next slide, this will hopefully illustrate what I mean. So in this particular instance, you can see there is a number of sequential steps from receiving a claim or an email with some documents on there through to being able to value a particular claim. In some cases, I think in this example, we've got 1 minute it took to actually process this claim. And through that, we're using things such as OCR in the documents, extracting data from documents in the machine learning, passing that into third-party systems to then be able to check and validate some aspects of the claim, for instance, vehicle registration numbers, validating the data, pushing that through a valuation model before you then obviously have an end result in terms of a report or some kind of valuation report, or let's say it could be an offer. So fundamentally, it's a combination of those technologies envisaged into a single end-to-end journey and then joined together. So in effect, it's passing the baton through that process that allows that straight-through process to happen. And one part of that, a key part of it, is the machine learning of the document in the way a claims handler would do. So once you're able to envisage this and you can put these claims chains together, then fundamentally you can then start to then apply this into what type of claims does this most applicable for. And that's where ultimately you then start to look at the volume areas, the more low value, higher volume type space, such as personal effects, and as you'll see in a second, personal injury, where you can start to then really make an impact in terms of that operational expense. Okay, so I'm now just going to go through one example, and we're using this example to automate a significant chunk of the recently launched official injury claims portal. Now, and again, what you can start to look at here is how the official injury claims portal was obviously released earlier this year, and it is really focused on the whiplash type claims area, where there are circa 600,000 whiplash claims per annum in the UK. Now, when you look at it in this way, the official injury claims portal gave with it a significant reduction in terms of the cost of these type of claims, the damages that were claimed on there. Fundamentally meaning that a whiplash that might have cost £2,500 pre-May would have been worth, let's say, £500 after May. So suddenly you're in the realm of a personal injury claim being less expensive than a mobile phone type damage claim. So fundamentally, if you look at it in that way, well, actually automating that type of claim fits into our first part of automation, which is the low value, less risky claims, whereby the quantum is £500. Well, a significant amount of these should realistically be automated. And we have done this with the official injury claims portal. Now, doing it this way, you can see the steps that we can run through, which is, again, similar to that claims chain I showed you before, which allowed you to then be able to obviously automatically value and validate those type of claims. Now, this is fairly straightforward things, but there are still considerations that you need to take into account when automating such type of claims. And really, the opportunities are there for official injury claims are significant, but also there are a number of pitfalls. Let me just take you through the opportunities in the first instance. First and foremost, the tariff injuries of official injury claims are less than £1,000, so it gives a significant opportunity and incentive to then be able to automate that. Would you want claims handlers to be obviously reading a medical report that's worth less than £1,000 in the same time and the same amount of effort of a claim that's worth £5,000? Well, clearly no. So it gives you the incentive and the opportunity. It also means that you can actually react to new behaviours. Because you're automating significant parts of the journey, you're in charge of how that claim is handled. And that gives you some real-time view as to how this market is developing in the claimant area, such that you can adapt. And again, going back to my original slide, having that ability to change your workflow and have that agile workflow in terms of that process means you can adapt quicker to change. It gives you the opportunity to automate things such as counter-fraud identification, which again is the stuff that risks your indemnity spend. And it also gives you the ability to auto-offer and move significantly into auto-negotiating of these type of claims. Finally, it also, in this particular instance, no one knows the value of some of the injuries that are over and above the official injury claims, whiplash, tariff injuries. So fundamentally, it can actually then standardize your approach here, which is important from an MGA perspective, to ensure your claim strategy is consistent and consistently delivered. In a human aspect, in terms of human handling, obviously you will have different people's interpretations of what an injury is worth outside of the whiplash tariff. In a more automated journey, you set the strategy, and this obviously delivers that to that strategy. So significant opportunities there to automate big parts of the official injury claims process. But there are a few things to take into account as well when automating this area. And so there are a few pitfalls that you need to avoid. First and foremost, then there are certain aspects of this that you may not want to automate. And the initial stages of this, which is the liability decisioning or indemnity granted, obviously is a key part of the process, whereby certain parts of it could be automated. You really need to do that with care. Fundamentally, in terms of making sure that you're not admitting liability or granting indemnity on cases which potentially you're not going to be paying further down the line. It's an expensive mistake. The second thing is, where we are with official injury claims is that they will invariably lead to different approaches from different people that are presenting these claims. So even within the claimant solicitor market, there will be different ways that they will view the claims and the value, which means that you will have different views coming back from them as to what they are willing to accept outside of tariff. And also with the official injury claims portal, as well as being a B2B environment, you will have a B2C aspect of this, which is the self-represented consumers who you'll be dealing with direct. And obviously from there, they will need to be guided through much more of a negotiation and perhaps even the human element of that to negotiate those claims. Luckily, they are still going to be only 10% of the claims presented. So fundamentally, the B2B type automation is still going to work well. And then the final bit, which is failing to capture data points will put you at a disadvantage. So unless you've got the ability to capture all the data around behaviours, about the official injury claims portal, be able to see what people are doing, and again using the capability that you have within unstructured data to then get insight from that data that you would not have seen otherwise, is going to be key. But similarly, it's a pitfall if you don't do that, because obviously that will leave you at a significant disadvantage. The market, you won't be able to see the market profile, you'll not see the behaviours in real time, meaning that your indemnity spend is going to, and your competitive advantage will obviously become diminished. So fundamentally, there are pitfalls to automation, but there are solutions. And just winding this right back to the start in terms of the prediction, whilst we can see official injury claims portals and things such as personal effects being automated, then from an MGA and insurer point of view, yeah, I would expect to see over the course of the next 3 or 4 years much more significant inroads in terms of automation of claims, if that target is going to be the situation that we're going to be faced with come 2030. With that, we've come to the end of the presentation, and I think now it's probably time for questions.
Thank you very much appreciated. So great presentation, lot covered there, but I think it was very well covered, and I think there was a sufficient amount of detail, but good to have the slide deck to support that along the way. So I do have a question for you. I've got a few questions actually. I think this one might be suitable for Chris Butcher. You've talked about business to consumer, but how do you see it working if there are brokers in the distribution chain?
Yeah, I think what was interesting in just listening to the last to Chris and Dean, I think a lot of the points made are equally applicable in B2B as they are in B2C. I think I was just touching on sort of the insurtech world. Typically, I mean, Sequence is one that isn't B2C, but there tends to be a prevalence of business to consumer. But I think most of the points we've talked about relate to an MGA, typically an MGA having sets of data that they can need to utilize most effectively, acting as an agent of an insurer. So I think really all of these points are pretty much continue to be relevant. And the more that's embedded within the MGA, if we go back to the headline of the whole session, was really the more that the MGA begins to look like an insurer, a full stack insurer, it raises the question of, is that a transition that's worth making, and is there any value in that? But fundamentally, I think that the points made are equally applicable in either area. Okay,
thank you for that, Chris. So this possibly is one for Dean. What percentage, if it's possible to put a percentage on it, of claims do you think can be automated once the OICP reaches a maturity in terms of usage?
I think that, it would be very high. My view would be it's probably in the 65-70% of volume of claims. A lot will depend on the level of additional injuries that fall outside the tariff in terms of the percentage of claims that will have that type of aspect to them. But I would still say that even in those areas, the value of those should be de minimis. And so therefore, I'd be saying high 65, 70, perhaps even as high as 75%, obviously, once you get to maturity.
Thank you. Chris McElduff, I think this might be for you. Too many technologies need you to make a big investment up front and then leverage it to create value. Is there a way that you can avoid the big upfront investment and link these to the value that we generate?
Yeah, thanks. It was a good question. I think the approach we see organisations taking in the market, and indeed a lot of the work we do to help our clients in the market, starts with doing a much smaller, what we would call kind of proof of value exercise, rather than taking that, big investment up front, let's build it and generate the return over a period. So much more of that focused, agile proof of value kind of piece. And then as you see the success of that, how you scale that, that's where you have the opportunity to look at a partner helping you with that and smoothing some of the investment out, and maybe linking some of the investment to the value that creates using kind of commercial structures. So in this space of exploiting data, building automation, we would see the market and we would advocate going smaller, focusing on proof of value, and then focusing on an engagement that with either the technology providers or partners like ourselves that generates a return on investment, and you use that to smooth out any big upfront costs.
Thanks, Chris. We've got a minute left now, so I'm just going to ask one more question. How would you advise us to start identifying the opportunities to get value from these technologies? Again, that might be one for you, Chris McElduff. We've got just a minute left.
Oh, well, I would obviously say come and talk to us at Davies, and we can help you. But no, I think generally what you've got to have is a handle on the journey, what that customer demand is, and what's the value and risk. So, mapping that out and understanding where risk and value can be, where risk can present itself and where value can either be created or destroyed. Start there, and then what you'll see is the places to prioritize, and that signposts you to where these different technologies that Christine and myself have talked about can be applied in different scenarios.
That's great. Thank you so much. So it just leaves me to say thank you to Dean Rowe, Chris McElduff and Chris Butcher and the Davis Group. And thank you to all of our participants for joining today. As I said, the slide deck will be sent post-event, and I would appreciate you completing our feedback survey. Just enables us to put on the best quality events. So thank you again, everybody, for joining us, and have a great day.